All right, welcome to the recorded version of my introduction to the options chain. This is hopefully to just familiarize yourself with the terminology and how to go over an option chain and like what to look for. That way, the next time you decide that you want to try to trade options, you don't just immediately get intimidated and. Um, so we got a few different key points that we can go over. What's an option? The difference between a call and a put. What does an option allow? Like, what does the actual contract go over? Um, you got the option Greeks. You got delta, gamma, theta, Vega, implied volatility. You got your strike prices, of course. Also, open interest, all sorts of things. So I'm gonna do all this in one cut. I'm not gonna edit really anything. So if it drags on, sorry. So an option contract controls 100 shares of whatever underlying that you're trading. So I'm going to try to use Caterpillar as an example for most of the things tonight just because it's just, everything has an options chain. I can just it has a nice breakout on the chart, so I can use it as an example. Um, so an option contract allows you to control 100 shares of the underlying stock without owning them. So when you buy your contract, you are putting those 100 shares under control, technically. And once you exercise the contract or whatever, you actually end up owning them. But as an options trader, we don't exercise the contracts, we just trade the differences in the premium, aka the prices of the contract. So an option allows somebody, so a call option gives you the right to buy 100 shares of the underlying at the strike price, regardless if that stock has gone up. So what that means is if your strike price of Caterpillar is 130, and it breaks out right here, and your contract expires at 137, just using this bar as an example, then that means you can exercise that contract and purchase those 100 shares of Caterpillar at $130 since that's your strike price, even if it's currently trading at the $137. This is beneficial for big money investors, big institutionals to hedge positions, and you know, a lot of big money buy the puts, which is, call options you need it to go up. Puts are like insurance when it goes down. So a call option allows you to purchase 100 shares of Caterpillar at $130 a share, even if it's trading at 137. And the whole idea is to get the contract while the premium is low and then sell it on these big breakouts while your volatility is high and you're way past your strike price, and we'll get into that in a minute and why that's important. So call option, just one more recap, what allows you to control 100 shares of the underlying and purchase them if you exercise the contract for the strike price, regardless of what it's trading at. As long as it's trading above the strike price. If it expires below the strike price, it expires completely worthless because it has no intrinsic value. It has no value at expiration. There's no reason to hold it at that point. Okay. A put allows you to control 100 shares and sell them at your strike price, regardless of if your stock is trading below that price, if that makes sense. It's the exact opposite of a call. So say you recognize that Caterpillar has traded into a resistance, and you're like, all right, well, this might pull back a little bit. So it's trading at roughly 140. So you're like, all right, I'll buy the 139 strike put. So what that means is once you go under $139, if your contract was to expire, you would be able to take those 100 shares and sell them at $139 because that was your strike price. That was the price agreed on the contract. You could sell those shares at $139 while it's trading at, 136.50 down here. That saves you potential downside risk because it allows you to, exit early in the future, if that makes sense. You can get out while knowing what happens. And these are mostly used by the big money. This is all the big institutionals that are mostly using these to hedge their portfolios. Puts are actually a pretty good way to hedge your 401ks or whatever, your big long-term accounts during market downside. Like if you were to buy S&P puts during the market crash and then sold them at the bottom and then just held on to all of your long-term holds, you'd be up a pretty good chunk of change. Um, so the thing with the options, when you buy the options, because buying and selling the options are a completely different ball game. When you buy the option, you buy a call, you're buying a long call. That means you are purchasing the call. You are not writing the option. You are not selling the option to somebody. Selling an option is a whole entire different can of worms, and you should never ever sell a naked option. Ever. But when you buy the options, when you buy a call or buy a put, a long call or a long put, it's giving you the right, but not the obligation to exercise that contract. So what that means is you don't if your contract expires in the money by like a dollar or like 50 cents, the underlying goes 50 cents above your strike price or just $1. Sometimes it's really not even worth it to exercise it because you're gonna have paid the price of the premium for the contract itself, and then you're gonna buy those. You're gonna buy those 100 shares of that stock for whatever price it may be, and if it's only 50 cents above your strike price, there's a chance that the day you actually own those stocks, you could dip or whatever and actually lose money on the position. So that's not even worth it. When you own the long call or own the long put, you have the obligation to exercise, or you have the right to not exercise it as well. But you have to be careful with your brokers because Thinkorswim will if you expire in the money, Thinkorswim automatically exercises you, which I went onto their support chat and actually bitched them out one day because that's not right and they shouldn't do that because it's definitely the decision of the purchaser. Webull actually has a really nice feature that you can, when you buy your contracts, you can check a box that says do not exercise this upon expiration. And that's a good feature to protect you in case you forget. Because sometimes you'll think that, oh, I'll just let this expire worthless because there's no way it's going to hit my strike price. And then, the market does some ungodly shit, and all of a sudden you own 100 shares of a $200 stock when your account's $4,000. So, so quick little recap. Calls allow you to buy the stock under what it's currently trading at. Puts allow you to sell the stock above what it's currently trading below, or selling at or whatever, downtrending at, however you want to say it. So puts are like insurance. Um, what we do as option traders is we try to get in while the volatility is low. Like when you see the moves like this, where this little descending triangle, what have you, where the volatility is contracting, getting tighter. This is when your contracts are going to be the lowest value because your calls are going to go down when it's downtrending, and your puts are going to go down when it's uptrending, and it's just going to kill the premium in between all this chop. So what happens is when the volatility is low and the chop, it's been chopping for this is like a month and a half, 2 months, the premiums are going to get really, really historically low. And once you have these breakouts, the volatility is going to increase, and you're gonna see those 400, 500 option moves that, people always boast about. All right, moving on. Let's see what else. This helps me not get so sidetracked. So we went over with the difference between a call and a put. The option allows you to buy the 100 shares and sell them. So the option the Greeks are what confuse a lot of people, but mostly what confuses them are just lack of understanding the terminology. So a good way to think of the Greeks is to just think of them as the x's and y's of an equation that calculate the price of the contract. So delta affects the price of the contract, gamma affects the delta, theta directly affects the price of the contract, Vega directly affects the price of the contract. So, you have all these factors, um, and we're just gonna go by one by one and kind of loosely, this is, like I said, this is mostly for beginners. So we're gonna start with theta because I feel like that's probably the most important one out of all of them. Theta, every option has a time decay on it, like a cost of holding the option overnight. Um, most people trade weekly contracts, which are the most lucrative, your highest risk, highest reward contracts. And just judging on this option chain right here, you can see that these contracts cost about 50 bucks, or sorry, they cost about 200 bucks, and the Theta's 27, so it cost about $27 just to hold that one overnight for that specific day. Every option deteriorates day by day, and they have expiration dates, so they can and they do often expire worthless. As option sellers, there are people who sell the options and get credited money for selling the options as soon as they write them. And when they sell the options, they usually don't expire for 30, 45 days. They want them to expire worthless. If those options expire worthless, they get paid the entire, credit of the premium that they collected when they wrote the option, if that makes sense. So at each end of the trade, the guy who's buying the option obviously wants it to go in the money and make a shitload of return, and the guy who wrote the option wants it to expire out of the money and expire completely worthless. So it's a double-edged sword. So theta works against the long buyer, the long call, the long put, and it works against the short call, short put, which is your option selling. Um, One confusing thing that, especially when I was learning options, was the difference between a long call and a short call. So when you buy a directional option, so when you buy a call, that literally means that you make money if the stock goes up. When you buy a long put, you make money when the stock goes down. Um, it means you are long that direction. Think of it like that you are long that direction. Um, let's see if I can doodle something. When you are short, okay, I don't know how this is going to go. Let's see. When you are a long call, this is your strike price. Once you go above your strike price, you just, theoretically make infinite profit. When you are short that call, hold on, let me make sure this makes sense. When you are selling the call, you need it to expire worthless. So if your strike is right here, you make your money when it goes further away from the strike. That makes sense. So you are short that direction. If you are long a call, you are long that it's going to go up. When you are short the call, that means that you are actually bearish on that call and you don't think that at expiration, you do not think that it is going to trade above that strike price. So you short that call. When you long the call, you expect it to go beyond your strike price and make money. When you are short the call, you expect it to trade below your strike price and collect the credit if you are selling that option. You are expecting it to expire completely worthless $0. Same thing with the put. I'll try to doodle it. So, let's see, this could be a strike. I don't know how to doodle this one actually accurately. I'm not going to bother doodling that one. So with a long put, you simply need the stock to go under your strike price in downtrend. That's like shorting the position. You need it to go down. You are long the direction of downside. When you write the option, when you sell the put, you are actually bullish on the position because you think that at expiration you believe that your put or you believe that the underlying will be trading at a strike price that is above your put that you wrote. It'll be trading at a price above your strike price. So that will make your put expire worthless. So you are shorting that put, which is a bullish signal, and then you are shorting that call, which is a bearish signal because you don't believe that your underlying will trade above that strike. So that was something that confused me, and if I had somebody explain it to me like that, I feel like it would be a lot easier. You don't see those terms a whole lot, but you'll read books, option books, and you'll see it, and it takes a lot of the bite out of the confusion. All right, so we went over theta. Theta is your time decay. It's your cost to hold overnight. Your theta is always going to be the strongest on weekly contracts because those expire that Friday. Even more specifically, from like Wednesday to Friday, your theta is going to absolutely chunk a contract if you're not in the money. If you're at the money, it'll still be pretty painful. Mondays and Tuesdays aren't so bad to swing into if you're at the money. But I do not recommend holding out of the money weeklies from Wednesday forward into Friday unless you know what you're doing. Unless you understand how the volatility works and this, everything that, goes into that. Um, the ways that you can get around theta is always so when you think expiration date, think buying time. You're just paying for theta because when you buy 2 or 3 months out, 4 months out, you're only going to be paying, pennies on the dollar to hold it overnight. Maybe $1 or $2, maybe, $3 or $4. But the premium on the contract is also going to be more expensive to do that. So you're paying for the time. All right, we'll start with delta. It's the simplest concept. Okay. Before we get into the Greeks, this will make a lot more sense too. In the money, at the money, out of the money. So you got 100, you got 102, 101, and the ticker XYZ is trading at 101 point, like 03. So these are your three strike prices, and XYZ is currently at 101. So if you were to buy the 101 strike, if you were to buy this one, this would be at the money because that's what it's currently trading at. Or sorry, we'll use call, long call. You're bullish on the position, so you want it to go up. So this would be at the money. This would be out of the money because it's not currently trading there yet. And this would be in the money. That's as simple as that is. That's all that means. At the money means that your strike price is currently where the stock is trading. In the money currently simply means that it's trading above what your strike price is. Out of the money simply means that it is currently not trading above where your strike price is. Out of the money contracts will always be cheaper because they have a less probability of expiring in the money. Your at the money contracts, will be like median price, and your in the money contracts will always be more expensive because they have intrinsic value, and which is a fancy way of saying that they will have value when they expire, that they will not expire worthless. Intrinsic value is a fancy way of saying that they will expire with value. Extrinsic value is just like, think of it kind of like the opposite. Extrinsic value is your theta, your time crunch and out of the money. Okay, so back to delta, back to the actual options chain. So this looks like Chinese to a lot of people, which I understand. But if you just take the time to look at each column independently, it's not so bad. Um, Bid ask, this is the price of the contract. This is your premium for the contract for your long calls and your long puts. The first question that's usually asked is, why are the prices listed as 2.19 or 0.95? You'll also hear people say this contract is 95 cents or this contract is $2.19. So the reason that is because, like we mentioned earlier, one contract controls 100 shares, and the bid and the ask value represents the cost per share of premium. So this one is $2.19 per share of premium. Times that by the 100 shares, you get 219 or whatever. The median price of this probably be like 240. So that's all that means, is you just have to multiply it by 100, and then that's the reason, that's the price, because these are the statistics for one share of, one premium, one share's worth of premium. So you have your expiration date in the middle. This tells you when the options expire. You can collapse it and see all the available dates. It'll show you the weeklies. You have the leaps down here. A leap is a contract that expires over a year out. That's all that means. The grayed out ones are ones that expire on the last Thursday of each month or the last Friday. Not sorry, I think it's the third Friday of each month. I could be wrong. It's worth a Google. And then the golds are the weeklies. So you got your bid ask, you got your dates, you got your strike prices. We went over strike price. What else? Your puts are usually going to be on your right side. Your calls are usually going to be on your left side. It'll also say right here, it says calls, it says puts. If you're on Thinkorswim, you can click it right up here where it says layout, customize. You can edit your option chain to display whatever values that you want. These are the only ones I really worry about. Okay, delta. Sorry, there's so much to cover. Um, your delta value is the um, is the dollar amount your contract will gain in premium per $1 increase in your underlying stock if you have a call. If you have a put, it's the dollar amount your contract will increase per $1 move to the downside. Since puts, you need the stock to go down, calls, you need it to go up. So we're going to use the 137 call example for Caterpillar, which is currently trading at 136.90. So this would be an example of in the money, at the money, or out of the money. It'd be at the money, right? Because it's trading at pretty much what the strike price is. So your at the money contracts are usually going to have a delta value between 30 and 60, which means that per $1 increase, we're going to use the 137, you're going to see just from the delta alone, you're going to see a $50 increase on this contract. So, the mid price, median price is going to be about 240 plus 50, you're at 290 now just from the delta. Um, that's as simple as delta is. Delta is the price increase per $1 movement on your contract, or dollar movement in the favored direction if you have a call or a put. You'll notice that the put side has a negative value on the delta, and that's just the directional aspect of it. You still gain that amount of money. Okay. All right, gamma. Well, hold on. So with delta, you'll notice the further out of the money that you go, your delta values get slowly down to zero. They start creeping closer to zero. The further out of the money you go, the less probability you have of going in the money at expiration. So your contracts become dirt cheap, and you might be asking like, oh well, cheaper contracts I can buy way more, and if there's a crazy move on Caterpillar, I'll make a shitload of money. They're cheap for a reason, because the market makers are expecting it to expire worthless. But it is true if you do end up getting a very explosive, move on Caterpillar close to 150, your delta is only $4 a contract. They only cost $13 a piece for the contracts. $4, you get if you get even 3, 4 strikes away from being in the money, you see these deltas up here about 22, 27, 32. If you go from a zero point 0.4 delta to a 0.22 and your contract only costs $13 and these up here about $90 to $100 a piece, that's why people get addicted to buying the out of the money options, because if you bought 10 of those for the same price as one of those, and you do the math. But moves like that aren't likely, and most of the time people get their ass burned. And you'll notice the further in the money that you go, the delta starts getting closer and closer to 1. And that's ultimately what you are looking for, is you want to get your delta as close to 1 as possible, because if you get that 1-to-1 ratio on your underlying moving a dollar and you have a 1.0 delta, that means every cent that your contract or your underlying is moving up, your contract is going to be moving up $1. So it's essentially trading like you own 100 shares of that stock. It's trading like you're, just trading commons. But buying in the money always costs more and can be more risky, in the sense that um, if it goes against you, you lose money quicker. If you buy at the money or out of the money, you get slightly more leeway. Okay, so gamma, we went over delta. Delta is the price your contract increases just from the underlying moving up $1. the gamma compounds onto the delta per $1 movement. So that means if we make the $50 on the 137 call, the next dollar would, the next $1 movement, so the movement from 137 to 138 gets us $50, which also makes the gamma increase the delta. So from the move from 138 to 139, you have that new delta of 56 because you take the 6 gamma and you add it to the 50 delta. Your new delta is 56, and your gamma is probably going to either stay at 0.6 or maybe move down to 0.5 because you're one strike further in the money, and your delta's that much closer to hitting that 1.0 ratio. Because you'll notice the closer in the money that you get, your gamma goes further down and down to eventually zero. So from 138 to 139, you have a 56 delta. So the first move you made $50, the second move, the point up, you made 56. So you can see how, if you get an explosive move in your favor, you can kind of see how the gains like compound so quickly, and you see that you're able to see those 200, 300% returns. So the move from 138 to 139, 56 delta, the move from 139 to 140, your gamma is probably going to be 0.5, and from your new delta is $61. So from a $3 increase, you made $50 the first time, 56 the second time, 61 the third time. And that's not even accounting for volatility, Vega, which is a whole other, factor that can positively increase the price of your contract on top of the delta, on top of the gamma compounding. So if all these stars are aligning, this is how, that's how you see those crazy returns on the options, which, you'll just kind of get more familiar with as you get exposure with them. This is mostly, like I said, meant to just kind of take the sting out of looking at the options chains. So quick little recap, bid and ask price is not actually $2.19 by $2.96. You have to multiply it by 100 because you're controlling 100 shares. So that's a 219 bid and a $296 ask. Same thing with the delta, you just multiply by 100. So you're not making 50 cents per contract, you're making $50. It's the same thing. Theta we went over. That's going to be your time decay. So next is Vega. I'm not actually going to pull the value. Well, I guess I can for this video, but I don't actually put the values on my charts because you can kind of see with your eyes when your volatility is highest. So Vega is your volatility. It goes hand in hand with implied volatility. When your volatility is high and the move is going in your favor, the premiums of the contracts will also rise. You'll see that like the Vega is 0.6 at the money where the most volatility is, and the further in the money you go, there's less and less volatility because the likelihood of going that far below your strike price is probably pretty low. But Vega is another volatility is another factor that affects contract prices. We'll go to the chart for this one. So whenever Caterpillar was chopping around in this range right here, bouncing, 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 your volatility is going to be way lower. Your implied volatility is going to go down. A normal implied volatility range is between 30 and like 40% probably. And the whole idea with options is when your implied volatility is low, your premiums cost less, and you want to get in while your volatility is low and sell while your volatility is high, which is a perfect example here. If you were super aggressive and took the entry on this pivot right here and bought a call, because price closed above the high of this candle. Volatility inside this pattern is like insanely low. So your implied volatility is going to be lower. And boom, you have this day right here that's going to kickstart your volatility up. And then, if you hold your contract the second day, you get this massive, like, what is this? This is a almost 6% move in one day. Your volatility is going to be through the fucking roof. So your Vega value is going to increase like dramatically, which is going to super inflate your contract A. Um, and if you bought like a 132 strike above this red line, even if you got in late, you made 5 points in the money. That's at least $400 just from that. And on top of your volatility, that's probably another, I'd imagine 200, like 100, $200 on top of that, just from the Vega and the volatility, like explosion. But the volatility can also work against you because if you're trying to swing trade, you have what's kind of going on with me right now is I'm in a caterpillar swing for earnings. And so I actually did hold. I got in somewhere along in this consolidation, and my calls are 150 strike. I'm trying to hold into the earnings run up. Um, I was up very nicely on these 2 days right here because my volatility was up so high. My contract strike price is 150, so they're like super out of the money. But I was up so nicely on them because the volatility increased so much on this day right here that my contracts were inflated. And then you see how it gaps up the second day and pushes even further. So the second day, I was fucking bankrolling right here because I was not only 10 strikes away from my strike price with over a month left on my expiration. My implied volatility and my Vega were just like fucking massively inflated. Um, so I was having a good 2 days until you have these two pullbacks. So you have this candle pushed up nicely, but it closed, almost 2.5 points under with a high. The next day, you have the volatility push up, get slammed back down. So you've got 3 days of a correction. What do you think happened to my implied volatility? It went way down. And what do you think happened to my huge gains that I was sitting on those 2 days? Yeah, I mean, I'm still up on the contracts a little, decent decent amount, but not nearly what I was because my implied volatility settled down as I creeped further away from my strike price. If that makes sense. The further away you get from your strike price, you start losing more and more value, quicker. Then the further you get to when you buy out of the money, the closer you get to your strike price, you start gaining exponential value. That's what can be lucrative about buying those out of the money options. Because if you somehow start to get close to being in the money, you don't necessarily have to go in the money. Like my Caterpillar play, if I somehow hit 147, 148 before earnings, the implied volatility before earnings is always its maximum. Like the 1 or 2 days before the earnings report, implied volatility will be 250% sometimes, when it's normally 30 or 40%. So that's why you'll see, for example, Tesla, they report earnings, I think, in like a week or two. And a normal Tesla option in the money for a weekly is around $1,500. For earnings, if you want to buy a call that's at the money a weekly, the day before earnings, you're probably going to pay $3,500 easily because the implied volatility is going to have inflated that contract that much, if that makes sense. So when you have these consecutive green days, when you own long calls, when you own call options, your implied volatility is going to be beefing these premiums up like fat. And these are the days that you want to get out if you're day trading options. You can always try to get back in, but when you have those explosive volatility days, it almost always hurts you to hold on to them for through the corrections, unless you plan to swing them until they're in the money, you know. Like if you have an out of the money option and it goes in the money on the same day as one of these huge, you know, green range bars, you're probably going to make 700 to 1,000% return on your contract. And that's where a lot of people, you know, get addicted to that kind of home run mentality and start developing bad habits of always buying out of the money, but you'll quickly learn how many times you lose doing that, unless you are just absolutely surefire in your analysis, you know, or you catch some lucky news announcement, you know. Like I turned $40 into 900 on Disney because I bought 10 contracts that were insanely out of the money, and Disney had an insane run up because of Disney Plus, and they never went in the money, but they got really close, and $40 turned into like 900. It was like over 1,500% return, I think, or something. It was crazy. Okay, so implied volatility. Volatility, you know, and it works the same way with puts. If you've got, um, you know, like right here, if you've got these 4 days of selling right here, and you know all of a sudden you start chopping around with these green bars and you have puts, you know, you need the stock to go down, your volatility is going to start decreasing down, you know, your downward volatility is going to start decreasing because you're going up when you're in a put. You know, a call long calls have their own Vega, long puts have their own Vega. Every contract has its own Greeks, you know. Yeah, looking at the Greeks can help you determine like which contract is better to buy. Because why would you buy, you know, you could buy two strikes out of the money and save $30, but your delta is 38 versus 50. So you're not going to make as much, you know, you're saving a little money on the premium for not even being in the money, you know. Open interest will be the next one that we talk about. Open interest is simply it's just a fancy way of saying that these are the number of contracts that are currently open that are people are just sitting on, and it can be a good indicator that, you know, if you do some technical analysis and you see an unusual amount of open interest on a contract, then you know, some big money might know something that you don't, type thing. See if I can find a good example. I was looking at one that I noticed like a massive open interest on, but man, I don't remember. Sorry, give me just a second. Open interest can be a good way to see if any big money is watching a specific strike. Like, okay, so GDX is a gold miners ETF that I'm bullish on. Specifically, it's trading at 39.31, and you'll notice that most of the open interest for the 21 August dates is, you know, you average around 11,000 open contracts, 12,000 open contracts. But if you look at this 40 call, you'll see that there are currently almost 70,000 open contracts for this. So that can kind of like alert you to, like, you know, if there's 70,000 open contracts on this strike price, maybe I should, you know, look at my chart, you know, throw up GDX on a chart and be like, let's see, you know, this is the weekly chart. You got a really nice hammer on the weekly chart. You know, so this is implying that over this previous high, you could see a nice push up, you know, past 40. So this just helps reaffirm that you're not the only ones watching that move. And you'll notice that other contracts, see this one, 107,000 open contracts for the 18th September. Does that necessarily mean that all these people are going to hold them all the way until they expire? No. A lot of these people are simply trading options because they're paying $220 for one of these contracts, and if GDX goes from 39, 31, and it goes to like 42 or 43, they're going to make 200 to 300% on their position. Probably closer to 150 to 200%. If you got 20,000 contracts of 100 to 200%, you do the math on that. Volume, I wouldn't really say is a great indicator of big money flowing in, but it could be an indicator of big money flowing out. If you've got a high open interest and then you've got high volume, people could be exiting the position. The open interest usually updates, as the day goes on. So if you're swinging, it's something to kind of keep an eye on every day. Kind of check your open interest, see if it's changed dramatically. All right, so we went over delta, increase in contract per $1 move of underlying. Gamma is the compound on delta per $1 move in underlying. Vega is volatility. So earnings, let's talk a little more about earnings. One thing that you'll see a lot of options traders do are call it earnings lottos. Disclaimer, earnings is pretty much gambling, no matter how you look at it. And your contracts have about 10 ways to go to zero and about one way that they can go astronomical in your direction if you're right. I've seen 40,000% returns and I've seen like 113,000% returns on Ulta before. But it's pretty much luck. Um, so implied volatility and earnings, this is kind of more of an advanced topic, but earnings, it's common sense that if a company provides good earnings, they usually shoot up like 5 to 10% within a night. And if they have, god awful earnings with bad guidance, they can drop 20, 30% in value. So, those percent values are really attractive to options if you are on the right side of that move. But here's the issue is a lot of the times, your normal implied volatility on a contract is going to be between 30% and 50%, right? So the week leading into earnings, your implied volatility is going to go from 30 to 50 to 60 to 70 to 100 to 150. Your implied volatility is going to go up to 250 sometimes, depending on the company, because that's the implied movement for that expiration date. So, and what happens is the contracts become super inflated, like ridiculously inflated and expensive. So what happens is people are like, oh shit, Apple's about to release earnings. I kind of want to buy a lotto and hopefully I'm right. Okay, cool. Um, the unfortunate truth is with the implied volatility being so high, most people don't usually want to spend more than 50 to 100 bucks on these, quote unquote earnings lottos. And with the premiums being so inflated, 50 to 100 bucks, you're going to have to buy super far out of the money just to even get into the trade. So if Apple's trading at 385 and they have earnings tomorrow and you want to take a $100 lotto, you're probably going to have to buy like a 500 strike Apple call. Like because the premium, 485 or 500 because the premiums are going to be that inflated just from the implied volatility. And so you have like a 1% chance of making money on that because not only do you need it to go like pretty far in the money to account for what's called a volatility crush, which I'm about to get into, you'll also have to account for the theta if you're holding a weekly contract, all sorts of shit. Um, staying on the topic of implied volatility, you have what I just mentioned called volatility crush. So basically, after these earnings events, like I mentioned, your implied volatility normally is sitting at 30 to 6, 30 to 40, 50%. The day or two before earnings, you're going to be sitting at 150 to 200%, 250%. So the day immediately after earnings, that expected move is no longer going to be unknown. So your implied volatility is going to immediately drop from about 200% down back down to 50, 40, 30%. So what does that mean? It means all your premiums are going to incredibly deflate, especially if you're holding a weekly contract that expires 1 or 2 days from now. Your premiums are going to deflate, and if you're wrong, everyone's going to be dumping the position. Even if you are right and you made a shitload of money, everyone still dumps their position because the volatility is going to do nothing. The implied volatility is going to do nothing but go down after earnings. The first 20 minutes of the bell at least, because the stocks can always keep running. That's always a possibility. But for the most part, everyone exits at the bell the day after earnings. So not only are people selling on the bid, the volume is sell pressure. People are exiting, exiting, exiting. The implied volatility has crashed. So the premiums are deflated and people are selling on the bid and getting out. So 99 times out of 100, you're going to wake up to see your option lotto at $0. Even if the move, if you had the 485 Apple when Apple's trading at 385 and Apple opens up at 440, it's still going to be zero if it's a weekly contract. Because there's going to be probably 0% chance that contract expires in the money, especially after that implied volatility has gone way down. So my advice for earnings is if you're gonna try to play earnings, get in at least 2 or 3 weeks before they report, so you can kind of try to get into that earnings run up, and you can kind of buy slightly out of the money, and if you get that earnings run up, you know, well, you try to use this one as an example. If you buy this strike, like it's like a 43 strike, and you've got earnings. Oh, what the fuck? And you've got earnings like, we'll say like right here. Your contract's going to be cheap as fuck, A, because it's out of the money. B, because your implied volatility is going to be low. So say you get your move and suddenly you're in the money. You still have a couple of days or weeks until earnings, and if you keep going up all the way up until the day before, suddenly your implied volatility has gone from, maybe 60, 70%, just because the earnings are kind of close at that point, maybe 40 to 50. You're at 250 to 300% implied volatility. Your contract alone just from that is going to be 2 or 3 times like higher just from the Vega, because your volatility is going to be in an upward trend. You know what I mean? And then if you sell the day before earnings, you don't have to worry about any of the volatility crush the day after. And if you wait until the day after to play earnings, you don't have to worry about any of the implied volatility inflation. You know what I mean? Playing earnings is just not smart. Playing before earnings and playing after earnings, that, can be pretty lucrative. All right. I think for a lesson one that this could be a pretty good stopping point. I'll go ahead and give one little like option hack that I'll try to explain the best I can when it comes to buying out of the money options. You take the weekly chart and you notice that after this run up, GDX pulled back, a healthy pullback. Once you decide that this chart has bottomed right here, you take your buy signal. Well, first off, hold on. Okay, so you take a candle, a previous high. So we'll take this one right here. The high was 37.49, and that candle was 1, 2, 3 candles before the bottom. So that's 3 weeks before the bottom. So what I was told was you take those 3 weeks and add 2 weeks, so you're at 5 weeks now. And that's how far out you buy using the strike price of the previous high. So using a quick little charting, just a quick little line. This would be our high. And so that would be, the 3 weeks, that's the 3 candles, and then plus the two that, that was just what I was told. That's 5 weeks of time at 37 something strike. So you round that up, 38. Um, and you buy those, whenever you get your buy signal. So you're buying the 38 call, and if you're playing absolutely safe, you wait until this high is broken right here. So you buy your 38 calls because that's the previous high, 5 weeks out because that's the formula, and you wait for your long setup, which is over, this is 34.70, and you're buying 4 points out of the money, 5 weeks time. So let's count it. How many weeks after your entry? You have 2 weeks until you're already breaking that high. So 2 weeks in, you're already in the money, and you still have 3 weeks to just gain that intrinsic value, which is a fancy way of saying in the money. The further in the money your contract is, the more and more and more intrinsic value that it has. Intrinsic value, think tangible value. Like once it expires, like you will be profitable on the position. Okay, one last thing. A lot of people ask about the break-even price of a contract. Like on Robinhood, it'll say, okay, so say that your contract your contract premium is 0.50, your strike price is 100, and then so you'll be on Robinhood and you'll see it say break even. And the number one question, break even 150. The number one question we get is, well, do I have to wait until it hits 150 before I make any profit on the trade? Negative. That is not true. Um, this simply means that if you were to exercise your contract, if you were one of the few people that actually care about exercising the contract, we'll say this is Apple. It simply means that if the strike price is 100 and you paid $50 for the premium, to make any money on exercising those 100 shares, Apple would have to be at trading at over $100.50 to accommodate those 100 shares that you paid premium for. I think I explained that horribly, so I'll try again. The break-even price is the price that the underlying has to be to just account for the cost of the premium. Because if you exercised your contract and bought 100 shares of Apple at $100, that's great, but you still paid $50 for the contract, so technically you're red $50 because you paid for the contract. So that simply means that there's no point in exercising until Apple is at least over 150 $100.50 because you paid $50 for the contract itself. So I just want to throw that out there too. Um, this is boring as fuck for you guys, I'm sure, because I didn't really do a whole lot of stuff on the charts. It was mostly me talking, but I hope it was informative for you guys. I'm gonna go ahead and try to upload it somehow. Um, yeah, I don't know what the fuck y'all doing in here, but